If you want to make serious money trading, you'll need to accept this uncomfortable truth. High returns normally always come with high volatility. Most traders quit when they hit their first 10, 20, 30% drawdown. But like most of the legends that have achieved very high percentage returns, they often have quite a high percentage drawdowns as well. In this episode, we're going to break down both of our experiences, with personally me going after maybe lower returns with more stable equity curves, and Pedmo going after higher returns but accepting more volatility. I'll also discuss a crypto strategy that I've been testing out on a low five-figure account and pretty much doubled it within 7 days. We'll also touch upon the two main philosophies dividing modern trend followers on whether to embrace or control volatility. Let's get straight into this. If you want to make a lot of money trading, you'll need to expect this. It's the one key element that most of the time will always come along with making a substantial amount of money in trading. Now, I'm going to let Pedmo talk about this topic because I think he knows it best. He's probably taken on way more volatility than me these past couple of months. So yeah, Pedmo, feel free to go straight into it.
The first disclaimer is that volatility is not always equal risk, but we'll get into that later. Think of it like the clearest example is like a drug dealer, right? Think about what he does. He takes a lot of risk, whatever, like legal, whatever the business, other drug dealers that might, have conflicts with him. There's a bunch of risks inherent to that business, but it's a business that supposedly, I don't know, pays a lot of money, right? Because you carry a lot of risk. And when you carry a lot of risk, you usually expect to get paid in the same measure. And the same thing happens in trading. Like if you are expecting to make a lot of money in trading, and let's not even talk about hypotheticals. Let's go to the famous traders that made a lot of money and are known. For example, let's talk about the most famous one, Jesse Livermore. For example, that guy, if you read his story, if you read the book, The Reminiscences of a Stock Operator, you'll see that that guy went through massive amounts of volatility. At one point, allegedly, he was one of the richest men in the world. But the amount of volatility that man took, it's insane. And you see the same in modern traders, like modern retail traders that did very well on their own. You'll see that most of the times they take enormous amounts of volatility and risk. And that's inherent in our field. If you want to outsize returns, you have to be willing to take that risk and swing for the fences. It's inevitable. There's no way that you're going to make a lot of money with super small drawdown, super small volatility, and you have that perfect equity curve always going up. That doesn't exist, in my opinion.
Yeah, I think I would mostly agree. I would assume that the only caveat here is probably things like HFT strategies, I would assume. Would you agree?
Yeah, but it's not making a lot of money. It depends on the scale that you trade, right? I'm saying making a lot of returns, like in absolute returns. But if you are making like 40% annualized returns or whatever it is, or like 40, even 50%, let's say, if you are making that on $10,000, you are making $5,000 a year. If you are expecting to grow a $10,000 account, even if that's possible for you, you're going to have to expect to take a lot of risk, and that won't come from safe strategies, in my opinion.
Yeah, I think I would pretty much agree. I'm trying to think if there's any exceptions that come straight to mind just for this general conversation. But I think, yeah, I would agree. For most of the time, to get high returns, at least in absolute, in like relative terms and percentage, you're going to need to take on a decent amount of volatility and risk overall. If you're obviously lodging a way bigger amount of capital and then you're making a lot less per trade, but then you're doing high volume, then obviously you can still make a lot of money, but it's just not going to be necessarily in a sense of return percentage. Do you think more volatility is always better most of the time for your strategy? Like, would you always trade a more volatile market, or do you kind of think about the cons of it as well?
It depends. I prefer for the type of strategies that I play that are trend following, that benefit from that increased volatility. At least the type of the binary type models that I'm trading right now. That increased volatility does help because your positions grow much bigger. They increase that skewness or that right tail of the positive trades, and all of that is great. So yeah, I prefer to be in crypto doing that. That's why I'm in crypto.
No, I think that makes sense. I think I've slowly sort of adapted to that mindset as well. I think at least for the next couple of years, I'll still be a decent percentage or a high percentage in futures. Because for viewers that haven't watched the other podcast episodes, I primarily trade futures instruments. So that's like ES and Q, YM, CL, etc., and they're all automated. Now, for the most part, futures you're never going to get anywhere close to the percentage returns you could get in crypto, but you're going to get on a lot less volatility, which means most likely your XE curve is going to be a bit smoother. You're going to have less severe drawdowns. Like, it would be quite abnormal for me to go into a 50% drawdown or something like that. But I'm pretty sure, Pedman, right, you've gone into like multiple, right?
Yeah,
Yeah.
for sure.
So for me, like a steep drawdown is probably 20 to maybe 25%. If I'm pushing that, probably something's actually stopped working. So for me, my percentage returns, I'm fine with. I think that's mainly because I get to apply a lot of leverage with futures. But ultimately in the future, I think I'll move more to having maybe smaller capital sizes, but then taking on more risk. Depends on what I really want to do, but I've been enjoying trading crypto like just a ton recently. It's just been so many cool opportunities, a lot of cool things you can investigate. I think I've pushed at least the limits for what I'm currently aiming for on futures. Not saying that you can't improve anymore, but for the most part, it's been very hard to find new strategies that work well with my current portfolio. So I've just been taking on the risk continuously and then just dealing with returns. Like this month for me was my first down month. I think it was 5 months, maybe 6 months, which is a really long period to have a, I guess, winning streak, I guess, whatever you'd want to call it, for green back-to-back months. But for me, this month was kind of strange in the sense that I had very high returns in the middle of the month. I think I was up like 7%, and then ultimately I ended down 2.6. I just wanted to get your thoughts on it. Because I mentioned in a recap video I did that those sort of months are probably more psychologically challenging than months that are straight drawdowns, just because you have such a whipsaw with being up like a decent amount of money and then basically seeing it fade away. Do you agree with that? Or like, I know for the most part you're pretty emotionless with your returns, but I just wanted to do general thoughts.
Yeah, that they can be tough, man. Even let me check here my charts. So even the past, even in late May, the market, like crypto, started to pump a lot in terms of altcoins, and like the last part of May, and I had enormous returns during that time, like enormous returns, very good for the time. And crypto just gave away most of that returns on a span of a few days. So I know they can be very frustrating times, but you just got to deal with it. It comes with the territory, and we need to look at it not at. I think at least this is what I do. I don't look at them at a few days scale or even weeks or even months. I look at quarters and years and what has been the CAGR for the last for the last amount of years that I have on my tests and stuff like that. And so trying to keep a very like long-term view, like a business, what's my P&L at the end of the year? That's all I care.
Yeah, I'd completely agree. One kind of more, I guess, tactical question, because I had a couple people message on YouTube thinking it wasn't possible, but do you check your P&L each day, or do you just simply have like risk alerts turned on?
No, I check my P&L each day, and I do it for a reason, because I have capital scattered across many wallets, because we are trading crypto and we have a bunch of things going on. And so every day I track what each wallet has. So in a sense, I have a daily P&L tracker, yes.
Oh, okay, interesting. At least for me, like at least for futures, I try and avoid it as much as possible. I just know like I pretty much check it, I would say, every 3 to 5 days. So about every time at the end of the week, I'm kind of checking overall P&L. But then obviously everything else I just have on alerts, and I try and like my brain basically ignores my portfolio unless I see an alert on my phone or on my desktop, etc. Then I'm checking it basically. Apart from that, then I try and ignore it. Obviously, I can see if trades are being taken, but I don't really like just look at like how much I made today or something like that.
Yeah, for sure. That does make sense. In trading futures or trading stocks or something like that, you usually have like stuff pretty well consolidated in one place, and that's fine. Like taking every few days, I just like to keep because there's a lot of things that could go wrong. I could be in like the other day. Exactly, this is a good point. If I didn't have my daily checker on Hyperliquid, I would have been liquidated, like on my positions, because I didn't check my margins correctly, and I did have a lot of margin on the exchange, and so I had to deposit more money. And so it's useful for me to keep track of everything every day. But you train yourself to be emotionless to the swings. You know that you have a positive edge, At least you are trading with positive expected value. You know why you have edge. You know that it works for a long time, and you kind of just chill out and take the position, take the swings as they come. That's your hedge, the patience that you can endure.
Yeah, 100%. Do you want to go into your topic about crypto trend models?
I just finished writing an article today. It took me a bunch of time to code this up, but around the skewness in crypto trend models. So um, to give a bit of context, the old trend followers all have the same philosophy around how you should trade trend. It's like the one entry, one exit, like you get a breakout or a multiple breakouts, like on multiple signals, whatever. But you never adjust your positions to allow for that positive skew, that long tail of returns. So, for example, let's take the example of BTC, right? Let's say that you take a position that you bought BTC on the, I don't know, on the bottom at January 2023, and you rode it all the way down to December 2024, right? So you have a massive position now, like almost 4 times the position that you initially had put on. An old trend follower will say that that is a feature of trend following, that you should have that massive position on your portfolio. While the more modern CTAs, like the ones that run modern trend following models, will say, no, you should put your positions back to a weight that both models your expectation of volatility and your expectation of signal, so that the single position doesn't contribute a disproportional amount to the portfolio. So what I'm trying to say is one side of these teams, like of trend followers, don't adjust their positioning, and the other side continuously adjust their positioning as their positions grow larger. The only thing and that's where the argument against, like, between each other comes from. It's like one side says, okay, no, but that's the nature of trend following, and if you mess with it, you are going to start hurting returns on the long term. And the other side says, no, if you don't do that, you are letting the market put a lot of volatility on your portfolio that you don't want. And so I wrote an interesting article on that, and how it's like relates in crypto trend, basically.
Damn. All right. Like I was actually reading some of it just before we kind of hopped on call. If anyone actually is wondering, I'll leave a link to Padma's newsletter. It's probably one of the best bang for bucks. Like it's how much is it per month? It's like $20.
Yeah, 20.
Yeah, like insane value, and especially for if you're trying to get into crypto, it's probably where I've learned all my stuff. Padma's basically been my source of knowledge for most of it. Obviously, I've read books from other people as well, but for the most part, especially doing trend modeling or anything like that, I think it's the easiest place to go.
Thanks, man.
Yeah, no worries at all.
I was just going to say, but you find this interesting nature because it goes right at the question that we started this podcast with. That is, do you want a lot of returns and a lot of risk, or do you want a small returns and smaller volatility? Because one controls the volatility, they target a certain amount of volatility that they want to the portfolio and keep it. And if a position gets too strong, too large, they sell it back down. And the others say, no, doesn't matter the volatility that the position contributes to the portfolio. That's the nature of trend following. Volatility, you have to eat it, basically. You shouldn't be trying to control it. And so those are two philosophies that I find really interesting.
I assume you're in the latter camp, or
I don't know. I'm trading both models. Like I have a continuous model going, but the bulk of my capital is in the former, like in the binary, like trend style models, because I'm trying to grow capital.
No, okay, makes sense. What is your deciding factor when you move over more capital to continuous? Is there a certain thing you're looking for, or how long you want to test it, etc.?
No, it's just when I want. I don't know, man. To be honest, this is a question that haunts me. Let's say, I don't know. I really don't. I've heard the arguments from both sides, and both sides are very, like, I think that they are sound arguments. For example, you have Paul Mulvaney. Do you know him?
I think I've heard the name. I don't know too much about his, like, how his strategy works or anything.
Yeah, so he has had, like, for the past 5 years, and I'm talking traditional finance markets. If my memory doesn't fail me, he has returned like 50% CAGR on normal markets, and it's like and he runs a binary old trend following model with a few modifications, but it's a binary old model. And he has run it since the 90s. Like he has a public track record since the 90s. So there's something like, how can I say, robust about a simple strategy that takes one entry, one exit, one stop loss, and that's it, So even though it's smarter, and I understand the arguments for the modern CTA trend followers, I still I still like the robustness of the old models, something that you can run for decades and doesn't change.
How much capital is he managing? Or is it personal?
I'm not sure, man, but multiple nine figures.
Holy shit, to do 50%. That's insane to do 50% on multiple nine figures.
Yeah.
Wow.
Uh, yeah. And it's all on those old trend following models. And yeah, that's the argument there. I understand that like stuff evolves and people get more modern, but what can you say when a person has been running a single model for decades? Like you can't criticize that.
Yeah, no, that's very true. Does he have any like online resources? I'd love to actually read more, and probably other viewers would want to as well.
It's very limited. Like I heard a podcast with him, and he doesn't talk much. He's like very reserved guy, just says the same things all the time. It's pretty interesting.
Oh, I guess if you're doing 50% a year, I guess, yeah, you wouldn't be talking too much. That is insane, though, to be doing 50% on multiple nine figures.
He
Wow.
has 100, according to IASG, he has 158 million in AUM.
Okay, so definitely still not the biggest fund, but like to do 50% on 158 is still incredibly impressive.
He's not the biggest fund, yeah, and this comes, in my opinion, right at the argument that we just made. It's much harder to sell a strategy that has a worst drawdown of 60%, which he has. Like he has a worst drawdown of 60% and a volatility of 36%, than selling a model that you can say, oh, we adjust volatility, we have a maximum drawdown of 25% or something like that. And you can do that with the modern CTA styles, because and those are easier to sell to clients, and that's where capital has gone to.
100%. This might get some hate on YouTube, but it's just a realization I've kind of had over the 6 years plus that I've been trading. When we both started out trading, right, we were both very broke. Well, at least I was broke for the most part. And one thing I never considered, and I think this is a very good point that you kind of were just talking about, is that most funds, especially when I've worked with some funds recently, everyone is way more focused on the risk side of things. Now, obviously, that sounds very straightforward, right? Like, why wouldn't they? But when a lot of us are getting started trading, I think we only think about in returns. I don't think I've never heard someone in the first year go, I want to target this amount of volatility. That's just it's not a word that comes out of someone's mouth in their first year of trading for the most part. And I think when people do get into, I don't know, like trying to understand hedge fund worlds or things like that, all of them still are only focused on returns. And it's also a funny thing where a lot of people bring up that, oh, well, these funds have only ever returned this percentage. And I remember, especially when I got started trading, I got some kind of like flack, I guess, or doubt from friends, because they would obviously bring up cases where, most funds underperform the market, most funds only, earn this X percentage, etc. But a lot of that also comes from the point that they are very limited on the amount of risk ultimately they can take on. Whereas when you're personally trading, you can be completely reckless and take on way too much risk, which is never good. But you can do strategies more like this, where you can have a 60% drawdown, etc., and you can still get amazing returns. It's just you're never going to be able to have a billion or a couple billion under management, because most people with a sizable amount of capital are not willing to take a 60% drawdown. It's just ridiculous for most people that have multi-millions in a fund, for example.
Exactly. It's all a question about what you're trying to do. Are you preserving capital or you are growing capital?
Yeah, I would say that's like perfectly summed up. I guess I'll move on to my sort of weird topic for this podcast. I wanted to talk about something which you also encouraged me to talk about, which was I took some kind of discretionary trades, I guess how you'd put it, on Hyperliquid. Now, Hyperliquid is just a decentralized exchange on crypto, and for the most part, I was just taking everything I've learned from small caps and applying it to crypto, pretty much for lower cap coins. Now, I traded small caps. Well, I still sort of trade small caps nowadays, but for the most part, I traded it quite focused for about 3 years, give or take. It was also where I kind of like made my initial capital returns, or like my first inefficiency, I guess you would say, which was amazing. I still love small caps, but they have become a lot more challenging. And also, I just don't really want to take on that much volatility anymore. I'm more just kind of trading futures. But one thing that was a very common strategy in small caps, which was shorting parabolics. Now, shorting a parabolic is pretty much just anything that moves X percentage in X amount of time. So a classic example was like 30% in 15 minutes in small caps. And primarily what that was is it in a very short period of time, you're trying to see if something's mispriced. You're trying to see, did it move on news? Was the news expected for this amount of move? Was it completely nothing? Does no one know why it's up? Is it just someone buying a large position, etc.? All those sort of things, right? And most of the time, it's a very easy mean reversion strategy. Now, sort of with the topic of this whole podcast, it's a very high volatility strategy. There can be a lot of ones which you'll enter and they'll instantly drop, I don't know, whatever, 20% of the move, 30% of the move, which is a really nice P&L gain. But there'll also be ones you enter which will move a further 10%, 20% away from your particular entry. And that's a lot of volatility to take on. It's also quite scary of risk. And the main issue of that in small caps was halts. And it was the main thing that made it quite an unattractive strategy, at least for me personally in small caps, because you never really knew if something was going to halt again, maybe on news, and you're going to be, left holding a position for multiple days, paying locate costs, or if it's just going to halt because it's a price halt, and then, it halts 4 more times because it just completely gets rammed up into the halt band, and then you're taking on, 100% additionally of where your entry was. So all those sort of things played into the factor where I just don't. It was an incredible edge, but it was also incredibly risky. So you really had to be happy to eat that risk, and you could definitely compound your account a lot, but you could also just lose it in a day quite easily. So in crypto, what I like about it is I don't have to deal with any holds. For the most part, they're quite liquid. They do run out of liquidity quite fast after the kind of the initial pump, at least from what I've noticed. But I don't have to primarily worry about that. And I also know I'll probably be able to get filled very quickly on anything that moves up higher. Because most of the time in crypto, things don't move up higher on very low liquidity for the most part. So you can definitely get filled, even probably get filled with limit orders, which is great. So you're not getting any of that extra risk taking on for those positions. So primarily what I've been doing is I've just been shorting anything that moved, I think it was about 10% in 10 minutes. And then I'll just have a quick news check scan, see if any news came out. Primarily, ironically for crypto, the best news place to scan is just Twitter. You just put in the coin token and you can probably find it very quickly. And then I was just applying a discretionary kind of regime filter, which is why I call this kind of a discretionary strategy, because I haven't perfected it yet or really know what would work best. But primarily, I wasn't shorting anything if BTC, for example, was rallying as well, or if it was linked to another token that was also rallying. Those sort of things I just stayed away from because I didn't really understand them fully. But everything else has led to insane P&L. Basically, I doubled a very low 5-figure account in I guess it's 6 days, 7 days, which is insane. I obviously could still lose it. So this is more just a conversation about what I found, what I'm sort of trading on the side. Not so much, I wouldn't say this is applicable to any new trader. If you're willing to take on a lot of risk and investigate this further, then obviously, you could probably make some decent returns there, but it's not something I would recommend by any streams because I just don't understand it fully yet. But it could be something where you can apply a lot of small cap techniques to crypto, and I think it could work kind of well. But anyway, that's kind of me rambling on about it. But what do you kind of think, Pedro?
Bro, there's the people that talk about stuff and there's the people that do, that go to the arena and test. So you are one of those people. That's why I encourage you to talk about it. I think it's a good idea. These tokens that go up and a lot in short periods of time and that shouldn't go up. That's a good idea to try and short them if they are mispriced. My only idea, my only concern is that when it's a bull market, it will be very hard to do that strategy on.
Yeah, I definitely agree. So that's kind of where that regime filter works. Like today, BTC is completely rallying. I basically didn't take any short trades today because I don't think it works very well. I am trying to look into if it can work the other way, where if something moves 10% in 10 minutes, could you long it in a strong environment and just basically do a breakout strategy of it? Maybe it's something that could work, but I've always found I don't know why. If I'm manually executing, shorting is a lot more comfortable for me. I have no idea why. It's just always been like that. I think it's because I started with small caps. So if I was to do longing, I would probably automate it because I wouldn't trust myself to actually execute it very well. And I think that's one part where you do need to understand yourself as a executioner in trading, at least from my experience. There's just some things I just am very poor at executing, like very fast decisions, things that I have to execute within a minute or two. I'm very poor at those. I'm not very good at longing. I think that's primarily from the fact that unless I'm longing something that I have ultimate conviction in, something like Hyperliquid or I don't know, SPY or something like that, I can see the reasoning why I'm longing. The ones where I have no idea why the fuck it's up 10% in 10 minutes, I just can't. My brain doesn't really let me let go of the fact that I have no idea why this is running.
Yeah. Why do like that makes sense, and I could see. I was thinking as you were saying, like why the strategy should work better than it did in the past. Because in the past you had a very short amount of tokens. Like right now you have so many tokens. Like we talked about the dilution of effect in crypto, because there's so many things that were launched, so much crap, and I do think that a lot there's not enough money. How can I say this? Before, money was very concentrated on a few tokens, right? Everything went up because there was not very many cryptos and everything was correlated to BTC. So if BTC went up, people thought, oh, I could be rich on this smaller coin, whatever it was. And everything that went up would go higher even more. Now you have a much more fragmented market in crypto. And I could see that strategy, why it should work. You're just pricing stuff that is mispriced, basically.
Yeah, I would agree. I also think like on a logical reasoning, I think that's primarily why it works. But on a pattern recognition side of things, of like what I noticed of why I wanted to take advantage of this is if you look at a lot of these, like let me just pull up my trade history because it's pretty easy to see what I was shorting. All right, yeah. So prompt. If you look at the chart, if someone pulls up the chart of prompt, it looks like a classic small cap from 2021, basically. You had an initial run up, it completely died, it sort of recovered, died, recovered, died, recovered, died, recovered, and it's just a never ending cycle until, because basically there'll always be some sort of news that comes out or some sort of event that happens that gets it a small push, and then ultimately all the people that had bought it at 30 cent, 35 cent are basically selling into these, and ultimately there is no fundamental reason it should be up so much. Now, if the news completely changed, let's say, I don't know, something insane, like it partnered with Ethereum or something, right? Then it could obviously be a reason why it could be priced at X amount, right? But until that sort of news, and that's the thing you're kind of playing against, is you're playing against on the idea that most of this is fluff news or completely just makes no sense of why it's moving up higher. Like another one I did was like Yuma. Another one was INJ. Like all of these pretty much look the same. There's
Yeah.
something that's been heavily overextended to the downside, and then they're getting some sort of pump, and then you can basically short it. Now, sorry, you go.
No, I was going to say even bid today. If you check like bid USDT, BID.
The BID is like a perfect example. This pumped like 64% in 4 hours. Now,
Exactly.
obviously, if you got a bad entry there or you were, early to it, you're gonna get some serious exposure, and you're probably gonna take a loss depending on how much you're risking on it. But if you waited, primarily what I looked for was like classic thing in small cap parabolics was a large volume red candle that broke either like a previous candle low or something like structural like that. It's a very basic way of doing it. I'm not saying it's the best. It's just kind of what I translated over from old parabolic strategies. Those can be great. You can also do classical technical indicators. You could do RSI, whatever you want to do. And those can be ways where you can find a better entry. I will say the most important thing, at least what I've learned from parabolics and small caps, and I think it sort of translates here, is most of the time these will fade further than you expect.
Mm.
A lot of people, I think, especially in small caps, the reason why it wasn't profitable for them was because they were taking very small winners for the most part. They were trying to get out as fast as possible. But you can kind of apply this to be a strategy where most of the time they will fade maybe 50 to 70% what they've moved before they really get a solid bounce. So you can make some serious P&L. Like on bid, if let's say you got an okay entry at low, you're probably getting about 19% on the downside, which is, a pretty insane trade.
Yeah. Yeah. Definitely. It's just like you said. You just have to figure out how to like get more accurate entries, I guess.
Yeah, I would say so. Or you have to be happy having that,
Scaling in.
yeah, scaling or having that exposure. Because like in parabolics, it wasn't uncommon to hear people having 100% stops. I don't know if that's the most effective method yet. I've only been doing this for well, I've been looking at the strategy for a while, but we made some side money on Hyperliquid. So I was like, why not? I'll just keep it on chain and deploy it and see how this kind of goes. And it's gone very well, but obviously I don't know. It's maybe next podcast I'll tell you this was a terrible idea. I blew up on one particular trade, but we'll see. I think it's an interesting trade.
That's my motto. Why not?
Your risk appetite, like for me, I would not be doing this if I was first into trading. Probably I would be because I was a degenerate at the beginning, but like if I had the knowledge I had now, I wouldn't be doing it if it's like my first $5,000 to trade with. But because this is like side money now, it's a very fun thing to look into, and then you can also make some solid returns. And if it's something that's actually scalable, then why not? I could probably scale it in the future.
Yeah, definitely. It's a solid idea, something that works elsewhere. It makes sense, makes practical sense. How to trade around it is that I'm a bit more skeptical, and not of how you are trading it, but I don't understand it because I'm a trend follower and I haven't studied many of like mean reversion, like the small caps.
Yeah.
I sucked at trading small caps back in the day. So for me, it's a bit more murky waters there. But in terms of the idea of the trade, why you put it on, it makes complete sense to me.
Do you find longing easier than shorting?
Yes.
Interesting. Well, can you just this is pure curiosity at this point. Can you break that down why that is? Do you have a theory or?
Why is it easier to long?
Yeah, for you.
Sure, because there's a longer tail there. I can make one trade can make me like 100 losses.
Okay. No, that makes sense. So you're kind of always longing with the idea that one trade could make you tons. Like, I'm not saying that's what the strategy is. I'm just saying that psychologically, that's what you're thinking.
That's exactly what the strategy is, in my opinion. It's like, yeah, it's like I'm taking like small swings, right, every day, like taking one trade here, one trade there, and just letting that positive expected value play out over time. Because sometimes I'll hit that trade that pays for a bunch of them, and it goes on. That's what I've been doing for many years.
No, it makes sense. Well, this was kind of a bit of sauce. I swear, if someone ruins this edge, this will be this will suck. But I think it's interesting. I don't actually know if it's something yet. I do think you're completely right. It is very like regime. Like if you're in a bullish market, this is not going to work. Right now, because BTC is a bit ranging, apart from today, it kind of worked. So it may be something that doesn't even work next week, but it was at least fun kind of exploring.
I'm not